this sector's up close, and we're talking energy. Oil is holding above $100 a barrel this Monday as the Strait of Hormuz remains closed, and Gulf oil producers are being forced to shut down oil fields for lack of storage. Modelling from investment bank Jefferies suggests US oil companies could be in line to see a boost of more than $60 billion if prices stay at this level for most of the year. But the picture is complicated for giants Exxon and Chevron, who have substantial operations in the Gulf. Money has been flowing into energy firms since the start of the crisis, though. The sector is now up more than 28% for the year. Peter Anderson is founder of Anderson Capital Management. Peter, last week President Trump said that US producers will make a lot of money from prices at this level. Is he right?
Well, temporarily, absolutely, because as we've seen, oil prices have spiked dramatically from this conflict. And of course, there is a historical precedence because we've seen in the past any historical situations where there have been conflicts like this, most notably the Ukrainian war, we do see this pattern. However, on the long-term aspect of this, we normally see oil prices subside.
Are international oil companies winners here then? Because they do, of course, own considerable assets in the Gulf.
For now, yes. As we're seeing oil spike like that, absolutely. And the other interesting thing about this is I think most people are not aware that even the countries that have oil dependency, they still are subject to the world price of oil. So that does help. For instance, in the United States, even though we are totally independent from oil production, we still are at the mercy of the global price. So as the price increases now, we certainly would have a benefit. Any company that has exposure to drilling oil, for instance, will enjoy that higher oil price, yes.
Do you think this would be a time then to buy into the giants like Exxon and Chevron, or do you think that the boom will be too short-lived?
Purely speculative at this point. I would say to investors that are thinking of speculating in oil, that's what it is, because the price of oil is going to change by the minute as this news is breaking. And as we all know, the news is developing by the minute. So until we reach some kind of equilibrium or there's discussion about a peace deal, I think you should expect continued outrageous volatility in oil prices. So it's only for the strong-hearted that want to purely gamble.
Trading arms of energy companies benefit from volatility, though, don't they?
Oh, they absolutely do. And we're seeing that now. As you mentioned earlier, Exxon, very, very high stock price, very strong, but we have to remind ourselves, hopefully, this conflict will not go on for a long time, and oil is so related to the news of the conflict that I would expect maybe people would begin to short oil in companies like this as they start to see a resolution in the conflict.
Where would you hedge your bets then? On Friday, RBC Capital Markets said it expected the conflict to drag on into the spring and Brent crude to be at $128 in 3 or 4 weeks. Where would you be betting?
Well, I would tell you this. I'm not a betting person. I'm a long-term investor. But if you're asking that question, I would say that when oil spikes at around 125, historically, that does seem to be a continuous pain point. And that might be, that's the focus, though, perhaps could be a trigger for a short to start building a position. But as I said, this is totally it avoids any kind of traditional investment analysis because there are so many variables that we just have no control over, and it's very hard to model the way you would a traditional equity investment, for instance.
You called it a pain point. It's also painful, of course, for the US consumer at the pump. But how insulated are Americans now from price spikes?
Sadly, they are not. And as I was saying earlier, when you're an independent energy producer, one would think that you had control over the price. But, you know, even if you mine gold, say, in Nevada, you still are going to pay the world price of gold. And it's the same thing with oil. Some investors think, well, if the U.S. has an independency, such a strong one, can't they set the price of oil? But it just doesn't work that way. It's an international price setting. And sadly, no matter how independent you are, you still are subject to those world prices rather than setting your own price.
Are US shale drillers a winner here, though? And at this price, will they be encouraged to extract more, which hasn't really been happening in recent years, despite President Trump's desire to drill, baby, drill?
Yes, that's correct. And, you know, we know that President Trump is very much a supporter of the shale production. So I would expect that to continue, but I would expect that to continue regardless of what's happening internationally. The U.S. has a very strong incentive to remain oil independent.